So let's get started with mastering internal controls and fraud prevention. This is the last in our series of books. Terminology. We have some helpful definitions here that we need to take a look at. First of all, it's bribery. Money or favors offered or given to influence the conduct or views of a person in a position of trust. Consent decree, an agreement between two parties sanctioned by the court. Example is is where a company or individual consents, agrees to stop questionable practices without admitting guilt. Another term here, counterfeits, a copy of a valid license, written authorization or legal tender being money, intended to defraud. Embezzling, misappropriation of another's property, almost always money is what it's referring to, and it's the misappropriation of that money for personal use in violation of trust. Forgery, a false document or a valid one altered with the intent to deceive, such as an altered check or credit card. Fraud, intentional deception perpetrated to secure unfair or unlawful gain. Larceny, unlawfully taking something, for example, stealing. If the stolen item or items are of great value, such as a large amount of money, it is grand larceny. Prima facie evidence that appears to be sufficient to establish facts unless rebutted, such as a person found at a murder scene holding a weapon. Subrogation, the substitution of one entity or person for another. Example, under subrogation, when an employer discovers that a bonded employee has embezzled funds, the insurance company takes the place of the employer to obtain return of the funds. And a bonded employee is one that you've purchased usually through an insurance company, so an insurance policy to protect the company in the event that an employee steals money, takes something of value from the company. And therefore, with subrogation, the insurance company who pays off the company for the lost property then has the right to pursue the employee who has embezzled the funds, has the legal right to pursue through the court system. There are 4 types of non-cash theft. Unconcealed larceny, the theft of physical assets, falsified shipping or receiving reports, fraudulent shipments, fraudulent write-offs. Now, the unconcealed larceny, the physical asset theft is the most common. Unconcealed larceny, well, remember, larceny is unlawfully taking something from another entity or person. Why is unconcealed larceny not reported? Unconcealed, not hidden? Well, people assume that coworkers are honest. Loyalty to friends. Seeing the world as management versus labor. Poor channels of communication. Personal involvement in the theft. Fear of job loss if the thief is a superior. We look at falsified receiving shipping reports. The most common kinds of theft. Well, with receiving reports, the normal goods are reported as defective to cover up the theft. Shipping reports, goods are shipped to a cohort's home or business address. Example, the thief puts an accomplice's address on the shipping report. Retailer example, same scheme. The goods are then returned for cash. Fraudulent write-offs can take many forms. Forcing the reconciliation of accounts. An example, stealing goods, then covering up the theft with a journal entry. And that journal entry would be a debit to cost of goods sold and a credit to inventory. So it's reducing the amount of inventory and creating cost of goods sold. It's increasing that. Altering inventory records, an example would be that the thief overstates the physical count of goods on hand to match the altered records, and that therefore covers up the theft. Creating a fictitious sales order, an example, the thief records a fictitious sale, then covers up the unpaid order by debiting the amount due, the amount to an overdue accounts receivable, or discounts and allowances, bad debts, inventory shortage expense. Writing off good inventory as scrap, then taking it home, or selling it and keeping the cash, or giving it to an accomplice. When is inventory theft most likely to occur? Well, when there is no centralized department to receive and store merchandise. Red flags of inventory thefts. Well, these include, and what you would want to take a look is over on pages 3 and 4 in your textbook. They have a bulleted listing there that you can review. We're going to point out a few here on the screen, but there are more on those 2 pages. One of them would be high levels of inventory shrinkage. I mean, yes, in business we can expect that inventory will be lost, but we don't expect it to, it should be within a certain level. Frequent customer complaints about shipment shortages. There's something that should raise the red flag. I mean, what's happening to the items if supposedly they were shipped? Where are they going? Unsupported adjustments to perpetual inventory records. Excessive purchases of materials or merchandise. An unexplained increase in cost of goods sold as a percentage of sales. Because again, if you're running the numbers, looking at the data, that should hold fairly consistent within a certain range from one period to the next. All right. 5 inventory internal controls. These are things that will help protect the assets, the business property. This is over on page 4. Proper documentation, properly monitored. You want purchase orders, receiving reports, sales orders, shipping documents. All of these should be pre-numbered and the numerical sequence monitored so that there are no duplicates, there are no gaps. Shipping documents should require a sales order. All right, so that you've got something to support that a customer ordered it before it's shipped. Paying an invoice should require supporting documents such as a purchase order, a PO, as they call them, and a receiving report, so that when you pay an invoice, you know that someone with the authority purchased it, and then you have the receiving report showing that it was received, that the quantity was received in good condition. Match it all up. Verify. All right. A system for storing and counting inventory. So this again is second in the 5 inventory internal controls to safeguard our assets, our inventory. We want periodic physical counts of all inventory. We want instructions on how to account for missing, unused, and voided tags. There needs to be a practical system for describing and identifying inventory so that when it's counted, we know what we're looking at to be sure that we've got everything, that we don't mistake something for something else. A third inventory control, internal control, segregation of duties. This one is so very important. Different employees should be responsible for the authorization versus the record keeping versus the custody of assets. So you don't want one person doing all of these tasks, because that then allows the opportunity for somebody who might be honest to think about, hey, I could do this and get away with it. So you want to separate duties. Here's an example. An employee authorized to initiate a purchase order cannot record the purchase and cannot receive the goods or pay the invoice. That's good. An employee working in the warehouse cannot have authority to initiate a sales order and cannot record incoming or outgoing inventory. Proper segregation of duties makes it difficult for one employee to commit and cover up a theft. That's precisely what you want to do. You want to thwart an employee having the opportunity. A fourth inventory internal control, physical safeguards. Lock up your valuable inventory. Restrict access to only authorized parties. Consider adding cameras, guards, electronic access logs. All kinds of things there as far as you've got the, you may have optical scanners or, passcodes, various things there that will protect. And a fifth inventory internal control, analytical reviews. Periodic checks of cost of goods sold as a percentage of sales. Is it higher? You want to monitor that because that may be a clue, a red flag. Percentage gross margin, where you take sales less your cost of goods sold, and that gross margin or gross profit figure you divide by sales and express it as a percentage. That again should fall pretty consistently from period to period. So you need to compare it. Compare this year with last year, this quarter with last year's quarter at this time. Inventory turnover rate. Take a look at it. Cost of goods sold divided by average inventory. How does it compare to last period? So again, compare it for the last couple of years, the last 3, 4, 5 years. Check, monitor, because if there's fluctuation, significant fluctuation, that's something that you need to investigate. Cost per unit. How does it compare to previous periods? Another measure. Now, which employees may steal? Experience shows that the employees likely to steal often express deep-seated resentments, have an inexplicably lavish lifestyle. They're driving that Porsche and they're making $20,000 a year. There's a clue. Have addictions, gambling, drugs, alcohol, and how do they support that? Are overextended, indicated by frequent phone calls from creditors. Here we look at a diagram, a triangle. We've got pressure, opportunity, justification. Pressure could be the addictions, overextended. Opportunity, the lack of effective high internal controls. We've got 4 internal controls in place. And therefore justification, which is a perceived mistreatment. The employee feels like he or she hasn't been appreciated, isn't compensated, hasn't been treated like he or she feels they should. Now, how to prevent employee theft? Well, to prevent it, do not hire high-risk applicants. We need to be sure that we have screening interview processes in place, that we try to weed out any high-risk applicants. So that we're going to verify the past employment, ask whether the person is eligible to be rehired. Be sure to obtain a candidate's written consent before checking. Check for criminal convictions. If Nexus or Choice Point does not have information, go to the county courthouse and check the criminal records in the criminal courts division. Require drug screening of applicants and possibly current employees as well. Be sure, though, that you consult a labor lawyer before implementing any of these processes or procedures. Check references. Actually call each one. Verify the degrees, certifications, and licenses. Perform internal audits and always include expense reports. What's being filed is an expense report. Purchasing records, sales records, cash accounts, customer complaints. Take a look at all of these. Have the audit performed by someone who does not handle the records audited. To have protection against theft, employee theft, well, theft insurance. Fidelity bonds covers routine theft and embezzlement. For you to obtain an insurance policy for specific employees who handle large amounts of cash, assets, inventory, something that is of high value. This theft insurance fidelity bonds covers commercial bribery and stock fraud, lost earnings from theft of lists. Optional riders may cover losses from counterfeit paper currency, money orders, forgery, such as deposits, credit cards, computer, all of these involved with that can be involved with forgery. Your company must prove that fraud was the cause of the losses claimed. There is an identified suspect. The policy's subrogation provision guarantees the insurer the right to sue the wrongdoer, so that the insurance company has the right to sue the wrongdoer to recover. No interference, that it guarantees that there is no interference with that right to sue for the insurance company to recover the funds, and that there's no settlement without the insurer or the insurance company's consent. Funds collected in excess of the policy amount are paid to the insured, that is your firm. Signs of employee theft, some typical signs of theft. An accounts receivable balance does not equal the sum of the subsidiary accounts received balances. Slow collections or unusually high bad debt write-offs. Checking accounts do not reconcile. Hard copy files include copies and not originals. For a complete list, take a look at page 18